Calvin here. There are only 29 days left before start of another year. This year, 2020, has been quite 2020. We have seen enough dramatic events since the start of the year. Just 3 days into the new year, an Iranian major general was assassinated by a US drone strike in Iraq. Everybody thought that Iran was going to strike back. Everybody was like, will there be a war between the two countries? Then the coronavirus has started scaring the shit out of us. China started locking down its major cities and soon the entire country. That was in late January. Then in late February, actually from February 18th, all stock markets have started waterfalling until March 23rd, when US Fed announced that they would purchase unlimited amount of asset if companies need money. Of course, this was to prevent domino effect and the 2008 housing bubble crash-like event. Then the stock market started rising, especially the NASDAQ. Then starting from early March, COVID-19 cases in North America and Europe had really started rising, and Italy locked down its cities. Then Germany, France, and UK, and all other countries. Then the Black Lives Matter movement across the continent, and even in Europe. Then the historical US election, Trump versus Biden. And all of them affected the stock market in different ways. Today, our question is, when will the stock market crash again? So that we can avoid losing money and even earn some money when it recovers. This is a timing question. Even the greatest investor, Warren Buffett, doesn't like timing the market. Instead, he focuses on buying great companies at fair prices. If you look back the stock market history, almost every time before a market crash, the market is overvalued, aka market bubble. Then something happens, like Lehman Brothers bankruptcy in 2008, which was the start of the 2008 market crash. The bankruptcy was on September 15th, and the stock market crash started on September 29th. 2008. Within this 2-week period, all the smart ones have sold their stocks, sit back and waited for the actual crash to happen. Today, I'd like to show you 3 indicators that say that the current stock market is probably overvalued. Before we do that, please click the like button below and smash that subscribe button for YouTube algorithm. Because if you do that, more people will watch my videos. The more people watch my video, the more I am motivated, and the more videos I will produce with better quality. So, how do we know if the market is overvalued, fair valued, or underpriced? There are a number of indicators that can show you that. But today, we're going to talk about probably the most important 3 of them. The first one is market PE ratio. I'm sure you have heard this before. The price to earning ratios of individual companies. For example, Apple PE ratio is currently 37.64. I don't know if you know this, but we can get a PE ratio for entire market as a whole. You can use this to get a feel of if things are overvalued. Basically, we can get a price of an index first. For example, S&P 500 index, which is a benchmark used widely in equity studies. This index indicates the price of S&P 500 companies, and then we compare it to the stock earnings. That is cost versus profit ratio. The higher the ratio, the more likely the market is overvalued. The more likely the market is going to correct itself. By small is a dip. By large is a crash. As you can see, the current S&P 500 PE ratio is a little over 37. In comparison, the historical mean is 15.86. The historical median is 14.83. This is not a good sign. This is even higher than the PE ratio of 1999, when the dot-com crash was about to happen. It was 32.9 back then. It means that current market is potentially overvalued. The highest S&P 500 PE ratio is 123.73, happened in May 2009. This data was just published today, December 1st, 2020. Let's talk about the second one now, This one was developed because not everyone thinks that the traditional PE ratio is a good indicator, because some businesses are cyclical and their earnings fluctuate over time. Thus, Professor Robert Shiller came up with an adjusted PE ratio called cyclically adjusted PE ratio, aka Shiller PE ratio. Basically, it's price divided by the moving average of 10 years of earnings, adjusted for inflation. As you can see, the current Shiller PE ratio is 33.46. In comparison, historically, the mean is 16.76 and the median is 15.81. The historical max was in December 1999 and is 44.19, again before the dot-com crash, not in 2008. And the current Shiller PE ratio is a lot higher than the historical average. However, the average of the past 20 years is 25.6, which would make things a whole lot of reasonable. The last one is Buffett Indicator. Warren Buffett does not like to time the market. He likes to buy good quality companies on sale, but he does use one formula to look how the market is looking. He said in a Fortune magazine interview that it probably is the best single measure of where valuations stand at any given moment. What Buffett measures is that the market cap of corporate equities divided by the nation's GDP. Basically, it's the total price of the stocks. It's compared with the total goods produced and service provided. The current Buffett indicator is 181.4% and is already historically highest. Buffett once said that the indicator spiking before the dot-com crash should have been a very strong warning signal. Perhaps it should be the same thing today. What this means is that the price of these equity is high compared to how much goods and services these companies are providing. So with all these three indicators are saying that the stock market is overvalued, will the market crash again in the near future? Before I tell you what I'm thinking, smash that like button and destroy the subscribe button for YouTube algorithm so that I can produce more videos with good quality. Alright, getting to the answer. To be honest, I don't know. And probably no one knows when will be the next crash. Like no one really knew when those market crashes happened in history before they actually happened. So don't try to waste your time thinking, is this going to happen this week or next week? Perhaps the best thing you can do is at least sell some of your stocks when the market looks like overvalued and buy back when it's not so much overvalued. It's safer for individual investor as well as healthy for our economy. When something is very expensive compared to its price history, perhaps you should sell, not buy. Unless that thing should be that expensive or going to be even more expensive in the future, like Tesla stock was, then you hold on to it. A lot of people suggest that we should invest in index stocks consistently without looking at their prices, like buying a few shares of S&P 500 companies every month without looking at their prices. That way, your decision is not affected by the current price. And since the market always goes up, you'll end up earning money from the stock market. But I think the better way is you can time the market a little bit, and your earning from the market will be much more than you don't time at all. For example, Canada Goose stock is probably a seasonal stock, like it sells, which is low in the summers and high in the winters, because their main products are winter jackets and parkas. I've talked about Canada Goose in one of my earlier videos. Please check it out. So you can buy Canada Goose stocks in the summers and sell them in the winters when the sales is high. That's it for today. I hope you enjoyed this video, and please leave your comments below and poke that little like button and smash that subscribe button for YouTube algorithm. As always, see you next time. I hope you all will be successful investors. Thank you.